Hi folks. It's good to see you all here again. Welcome to today's video about unlisted stocks. What are unlisted stocks? Unlisted shares or stocks are shares or stocks that are not traded on a formal stock exchange. For example, Geo and Ola both have shares that aren't on the stock market. In the same way, many companies haven't gone public yet because they don't meet the requirements to be on a formal stock exchange. Since they are not on a stock exchange, shares that are not listed are riskier than those that are. They are less clear, but their prices are more stable. So, if you can choose an unlisted share that has a good chance of getting listed in a growing company, you can make a lot more money from that share. Is it safe to buy unlisted shares? Over-the-counter, OTC, trading is how shares that aren't on a stock exchange are bought and sold. The buyer and seller of these shares trade the instruments directly, and some middlemen connect them. So, since this market isn't regulated or organized, trading in shares that aren't on a stock exchange poses a credit risk. But unlisted shares are usually traded between companies, large brokerage firms, high net worth individuals, HNIs, and institutional clients. So, if you look at the reputation of the people who buy and sell unlisted shares, you can reduce the risks. The risk also goes down if you trade in unlisted shares through the right middleman. The biggest risk, though, comes from the choice of investment, whether or not the company whose unlisted shares you're buying will go public, whether or not the price of shares will go up, or whether or not the company will fail because it has no business. Before buying an unlisted share, the only thing you can do is do a thorough analysis of the company's fundamentals and other factors. Difference between shares that are not listed and shares that have been taken off the market. Delisted shares are not the same as unlisted shares. Both of these kinds of shares are very different from each other. Unlisted shares are ones that haven't been put on the stock market yet. Delisted shares, on the other hand, were once on the stock market but were taken off for some reason. On OTC markets, you can buy and sell shares that aren't listed, but you can't buy or sell shares that have been taken off the market. Delisted shares can't be bought or sold on any platform, including formal stock exchanges and over-the-counter markets. Companies have unlisted shares when they don't plan to issue an initial public offering, IPO, or don't meet SEBI's requirements to list the shares on a stock exchange like NSE or BSE. On the other hand, a company's shares may be delisted if it doesn't follow the disclosure rules set by SEBI and stock exchanges. If this happens, the company's shares will be removed from stock exchanges, or the company's management may decide to delist the company itself. Unlisted shares valuation. The fair market value, FMV, method is used to figure out how much shares that aren't on the stock market are worth. Since they aren't traded on a stock exchange, there isn't a real market price for them, so the underwriters or investment bankers figure out their FMV. For figuring out the fair market value, you subtract the book value of all the company's liabilities, L, from the book value of all its assets, A. The result is then multiplied by the paid-up value, PV, of equity shares and divided by the company's paid-up equity share capital, PE. FMV equals A minus L multiplied by PV/PE. The DCF, or discounted cash flow, method is another way to figure out how much shares that aren't on the stock market are worth. Here, all of the expected cash flows in the future are added up and then discounted at a certain rate to get the share's present value. This method is hard, though, because all of the cash flows aren't real but are expected. However, investors in unlisted shares use this method a lot. Effects on tax. Since unlisted shares are different from listed shares, so are the tax consequences. If unlisted shares are sold within 24 months, the profits are subject to short-term capital gain tax and are therefore taxed at the marginal tax rate. But if you sell it after 24 months, you'll have to pay 20% long-term capital gain tax and get the benefit of indexation as well. But until the shares are listed on a formal stock exchange, the profits are based on FMV. Once the unlisted shares you bought get listed on the stock exchange and you sell your investment, the tax consequences will be the same as for listed equity shares, which means you'll have to pay 10% long-term capital gain tax on profits over 1 lakh rupees without the benefit of indexation. Conclusion. If you choose the right one, an unlisted share can be that hidden gem. It can give investors returns that go up and up and up. When choosing unlisted stock, the fundamentals of the company and the broker through whom you will buy the shares are the most important things to think about. Before moving to our next video, don't forget to like, subscribe and share.